Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 9th of July 2019 and we're commenting on the state of the US oil market and its implications for the world economy and why we believe global oil prices will eventually fall. Since 2017, we've produced a number of YouTube videos on oil and what its price, demand and supply indicate for the world's economy. On the 12th of June, our latest video on the subject, entitled Oil Demand Down, Recession on the Horizon, we've placed a link in the description below for those who haven't heard it, we stated that Reuters reported, quote, "World oil markets have undergone a U-turn. Switching from supply-side risks like OPEC's production cuts or US sanctions against producers Iran and Venezuela, analysts said, to concerns of slowing consumption amid fears of a global recession. As a result, crude oil prices have turned a 45% price rally in the first 4 months of the year into a slump of more than 15% since late April. US investment bank Goldman Sachs said on Wednesday that weakening economic growth and lower oil demand expectations were the largest driver of the move lower over the past month in crude oil prices. And with the outlook dim amid trade disputes, especially the one that has led to an expanding exchange of tariffs between China and the United States, analysts have revised down their oil demand growth forecasts, unquote. It also reported that energy consultancy FGE revised their global oil demand forecast down from 1.3 million barrels a day to 1 million barrels. Barclays Bank did a similar projection, and research firm T.S. Lombard expressed concerns that an unresolved Sino-American trade war, quote, has the potential to trigger a recession in 2020, if not before, unquote. So why are we commenting again today on oil, you may ask? Well, yesterday morning, Reuters came out with another report, which states, quote, Goldman Sachs said growth in US shale production is likely to outpace that of global demand, at least through 2020, and limit gains in oil prices despite output curbs led by the Organization of the Petroleum Exporting Countries. The Wall Street Bank forecast US oil output growth at 1.3 million barrels per day and 1.2 million barrels per day in 2019 and 2020 respectively, which compared with its global demand growth expectations of 0.8 million barrels per day and 1.6 million barrels per day respectively for the same periods. Now, we are all aware of the manipulation of the oil market, where essentially OPEC members agree the level of oil production and therefore price. To some extent, they have enabled the US to compete with them in this market without affecting price too harshly by cutting their own supplies. In fact, Goldman Sachs predict that despite this news of increased US production, prices will remain more or less unchanged at $60 a barrel for Brent and $55.50 for WTI. Now, it was only a little over 3 years ago, in fact January 2016, when Brent crude prices fell below $30 a barrel. And we stated then, when others thought prices would collapse to below $15, that the true price of oil, which was sustainable, was in fact around this $30 level, but we felt the prices would eventually rest between $50 to $60. And we held this ground even when prices rose back above $80 a barrel in October 2018. This $50 to $65 a barrel Brent crude price, and around $5 cheaper for WTI, is an acceptable sweet spot for these oil companies. However, for industry, the reality is that it is paying more than it needs to. Saudi Arabia can in fact produce oil at below $10 a barrel, while other countries can do so between $30 to $40, and shale oil producer costs range from $40 to $90, depending how you evaluate those costs, though these are falling significantly with new technology and innovation. So this is why that $60 level is so protected. It makes enormous profits for Saudi Arabia and other OPEC countries, and enables the US shale industry to grow and expand to the point that the US is now self-sufficient in oil if it needs to be. For us, the consumer, it's a bummer. That's a technical vernacular banking term for a shame. With oil at $30 to $40 a barrel, industry costs would plummet. Precious metal mining companies would see their costs significantly reduce, enabling them to extract precious metals at much lower prices, and the freight and cargo industry would boom. On the flip side, whilst cheap oil is great for American and world consumers, it would lead to stock market falls, especially energy company shares quoted on the S&P 500, and the US domestic oil industry workers would also suffer. On balance, though, we believe the world would be better off with lower oil prices, as its price is reflected in so many of the items we both import and export. In reality, though, that sweet spot is likely to be retained, even though global oil demand is down and there's frankly far too much supply. We can, over the next few months, witness this battle between producers, such as the US shale oil companies, competing with OPEC, and our overall prognosis is that eventually prices will have to fall. It may take a year or two, but the math is indisputable. Too much production and weakening demand. One thing we know for certain, save any major manipulation or war that is, high supply, lowering demand, and a move away from oil technology, especially in the automobile sector, can only point to one direction for prices. The question on everyone's lips is when. So what are your thoughts? Do share. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.